First off, I don't think anybody has any idea of how high fuel costs can go. It all depends on what actually happens. As far as blaming high fuel costs on Ukraine, a month ago, 2 months ago, before Ukraine was really even a topic, we had spiking fuel prices. The spiking fuel prices, yes, currently, I mean, it is part of the equation, but it wasn't the equation in the equation a few months ago. So, to blame high fuel prices on Ukraine, I think it's obfuscation is what it is.
I mean, do you think anyone's going to believe this, that Ukraine is causing all this? Because we saw fuel prices move up from 2020, right after the election, until
Right.
Christmas, when they all of a sudden used the reserve fuel deposits to bring it back down. Do you think people are going to really believe that it's Ukraine that's responsible for all this?
Well, Dave, what was the very first executive order that Biden signed? He shut the pipelines down. So,
Right.
I mean, no, a rational, sane person, there's no way they can believe that what's going on in Ukraine now is the reason gasoline is $3.50 or $4 a gallon at the pump.
Do you think Biden can change this? I mean, they shut down the gas pipeline. They basically stopped the lease agreements in Louisiana and many other places. Do you think he can reverse all this if he went ahead and said, okay, you can have the Keystone pipeline, let's have the leases for Louisiana? Can the fuel prices be brought down again if he reverses all of that?
Well, I mean, you're using the word if. Yeah, of course. I mean, if he reversed all the policy that he's put in place over the last year, yes, of course, you would see oil prices, gas prices, you'd see those start to soften. Now, the question is, will he reverse these things? I think it's all part of, if you want to call it, the plan.
What plan are you talking? You talking about the Great Reset or the Green New Deal?
The Great Reset. I mean, the takedown of the United States. Think about higher oil prices, higher gasoline prices, higher heating prices, cooling prices in the summer.
Mm-hmm.
What that amounts to is a huge tax on the American public. It's a tax across the board. And what that does is it takes a bigger and bigger portion of someone's monthly budget. So, like I said, I think it is part of the plan of gutting the United States. What you're doing is you're really sticking a knife into the middle class and lower class part of the population. It's an outright tax, and this is something not many people have talked about, but I can remember, I mean, go back 5 years, 10 years, 20, 30 years. Whenever oil prices started going higher, you would hear the financial press talking about, well, this is going to act like a tax on the public. It's going to slow the economy down, et cetera, et cetera. You're not hearing that now, but that is still a fact, that higher energy prices will cause lower consumption in the economy. So you add that to with what the Federal Reserve says that they're going to do by cutting back on their purchases and basically QT. What I'm going to tell you is if they want to try to save the system before the end of this year, you're going to see another episode of QE.
Let's just stay on this track for a sec. I mean, so fuel prices is like a hidden tax. Inflation is a hidden tax on the American public. So where are we with
Correct.
Where are we with inflation? Because in the beginning of 2021, they told us it was transient. And then, of course, they had to walk that back. And now there's inflation. Now they're talking about 3 Fed rate hikes. Some people say 2. Some people say we need a lot more. Do you think, because of everything that's happening, do you think the Fed will be able to tighten? And you're saying they're going to need more QE. Do you think they'll be able to tighten and raise their rates to control inflation?
No. I mean, it's simple as that. I think they'll probably raise rates once, maybe twice, maybe even a third time. But understand that the entire system is held up by credit. And if the Fed, who basically is the buyer of last resort, if they step back and they stop making the purchases, who's going to be the buyer? And what's going to happen to interest rates? You'll see a massive spike in interest rates, and you will see the credit markets literally implode because the biggest buyer, think about this. They're talking about QT. They're talking about running off their balance sheet. My question is, who's going to be the buyer? Who's going to buy all of these bonds that the Fed is going to liquidate or just run off? I mean, who's going to step up and do what the Fed has done? And I mean, going back to 2008, you must understand that the financial system and thus the real economy also has been on life support. So what they're saying is they're going to pull the plug on life support. And what I'm telling you is the system is so indebted right now, the system is so fragile and unstable that pulling the plug, they're going to have to plug it right back in. And they're going to have to reverse and again begin QE. Otherwise, you have pretty much an instantaneous implosion.
So if they can't control inflation then, because you're telling me that they're going to try the interest rate hike, they're going to try to tighten, but it's not going to work. If it doesn't work, isn't the Fed kind of trapped then? Because now, I mean, if they reverse it and they start QE again, I mean, people are going to start to realize, okay, the Fed, they can't do anything about this. They have no power whatsoever to control what's going on.
Right. People should have realized many years ago that the Fed was trapped. They are absolutely trapped. And at this point, they're publicly trapped. In the past, you had to think it through. You had to think about the end game. You had to look forward to understand that they were trapped. At this point, if they do try to raise rates, if they do try to slow money supply growth, if they try to shrink their balance sheet, then publicly, the Fed will be shown to be in a trap of their own making.
Do you think inflation is the fiat-like killer or destroyer? Because when you see inflation, it really means the devaluation of their currency. And if we continually see this, doesn't this hurt their system, and doesn't it benefit gold and other assets? And people, I mean, do you think this is going to wake a lot of people up? Because we've never seen inflation like this.
Well, we did 40 years ago, but it's going to slap people in the face is what it's going to do. And think of inflation from two different viewpoints. One from the viewpoint of just the average guy in the street. His gasoline's gone up, his food's gone up, his ability to heat and cool their home has gone up. The cost of living on everything has gone up. So that's one side of it. The other side of it, okay, so they're admitting or saying that we have 7.9% inflation. John Williams says it's 15%, and I would think, and he does the numbers from the way they used to be calculated back in the 70s, 80s, and 90s. So if inflation's, even if it's just 7.9%, and you've got what, a 2% 10-year treasury, so what does that give you? It gives you basically real interest rates at negative, call it 6%. And if the real inflation rate's 15%, then now you're talking a negative 13%. So the inflation itself will cause less purchasing of debt. You'll see people liquidating debt, and that will raise interest rates. The raising of interest rates on top of the most indebted system. We live in the most indebted system in the history of history, bar none, under any way you want to measure it. We are more indebted now per capita, per GDP, per cash flow, however you want to look at it. We're more indebted. And if interest rates start going up, how is everything bought? Everything is bought with credit. People buy houses people buy cars with credit. It will make it more and more difficult to liquidate a home. It'll make it more and more difficult. And it makes it more difficult because people's income doesn't go as far with higher interest rates. It'll make it harder to purchase cars. It'll make it harder to do pretty much anything and everything in the real economy. But more importantly, in the financial economy, or from the financial standpoint of it, think about the derivatives that are outstanding. Every single derivative has an interest rate assumption when that derivative is written. And if you change the interest rate assumption, and for the last however many years, the assumption's been 1%, 0.5%, 0.25%, and now we might be looking at 2%, 4%, 6%, who knows? What that does is it guts that derivative. And you're talking about well over 1 quadrillion worth of derivatives. So you're talking about smoking the financial system is what you're looking at.
It's funny, you're bringing all this up, and I remember this is many interviews that we did a while back when we talked about freezing accounts, taking the people's money to fund certain things. And what I find very interesting about everything that we're witnessing right now is that Canada, all of a sudden, Trudeau has the Emergency Powers Act, and they're freezing people's accounts. Do you think this is the beginning stages of where they're trying to bring us, where they can just freeze people's accounts without asking any questions because the system's coming down?
Well, that obviously is the danger of central bank digital currencies. If they don't like what you say, if they don't like what you say or do on social media, if they don't like what you read on the internet, I mean, it could get to that point. They can shut you down. And what Canada did, and they're apparently trying to reverse the freezing of bank accounts. What they've done is they've basically tipped their hand, and it's as bad or worse. If you want to go back, what was it, 3 years ago, 4 years ago, when you had Washington officials threatening, and even longer ago than that, I think it was back in 2014, you had people in Washington threatening to cut Switzerland off the SWIFT system, the wire system. And for the last 2 or 3, 4 years, they've been threatening to cut Russia off the SWIFT system. So what did that do? Russia basically has worked and created their own settlement system. So, I mean, they've sold all their treasuries, they've replaced it with other sovereign debt, and they've replaced their reserves partially with gold, and now they have their own settlement system. So by warning, by saying this is what we're going to do, by threatening, rather than threatening, it was a warning. They heeded the warning, and now I don't see how sanctions really work because they really don't have to use the SWIFT system. Now, jumping back to Canada, what they did with these bank accounts for people who sent $10, $20, $40, $50, $100 to the trucker convoy, and these people had their bank accounts shut off. What this is going to do, in my opinion, is it's going to absolutely create a stampede. The herd, they're moving the herd, and the herd is going to just stampede. And when I say stampede, I'm talking about taking money out of banks, buying gold, buying silver, buying Bitcoin and holding in individualized wallets as opposed to on things like Coinbase. The whole idea is, I really think what they've done is they've undercut their banking system, because who wants to put money in a bank where you could wake up tomorrow morning and you're frozen? You got no money to pay your mortgage. You got no money to pay for food. You got no money to pay for anything. You're stuck. And I think people are going to see what they just did, and they're going to react to it. And the reaction will ultimately, I think, be severe.
Yeah, I mean, you talk about the banking system going down because of bank runs. I believe when they started to freeze people's accounts in Canada, I think there were 5 banks that went offline because people were trying to get their funds out. So I think when this happens, when they freeze your account, and you try to get it out, I think at that point it's too late because there's no way to get to it. I mean, it's almost like if we had, if you remember back in Greece, when there was a bank run there and everyone ran to get their funds out of the banks? I think it was Greece, if my memory serves me. Cyprus, that's what it was, yes. And everyone ran to get their funds out, but they couldn't get it out because they shut everything down.
Then what happened? They reopened. When they reopened, people had 30% of what they had before.
Right.
It was a 70% bail-in. Bail-in. And it's important to remember, and we've talked about this over the years, Dave, FDIC now has written in code that there won't be bailouts, there will be bail-ins. And obviously the bail-ins, the capital for the bail-ins will come from customer accounts.
So everyone believes that the FDIC, if anything should happen today, they can just, let's say a bank shuts down or something happens to it, they can just go to the bank. Let's talk about being prepared. Concerned about the future? Join the club. Global problems are having local consequences. Too many of them. Take food shortages, for instance. Supply chains can break down at any moment, and we've all learned the hard way. That means now is the time to get yourself some emergency food from our good friends at My Patriot Supply. They're America's largest preparedness company with millions of happy, well-prepared customers. Their food lasts up to 25 years in storage. It's an insurance policy you can eat. When you need it, it will be there. Act now and save $50 on a handy 4-week emergency food kit. This kit provides breakfast, lunch, dinner, drinks, and snacks, totaling over 2,000 calories a day. Every person in your family should have one of these. Go to my special website, preparewithx22.com, and save $50 on each 4-week food kit you purchase today. That's preparewithx22.com. Those who know what's coming are using today to prepare. Go to preparewithx22.com or click the link in the description. And the FDIC will just say, here's your money. I mean, is that the way it works? Where people, you just say, oh, yeah.
That's the way it used to work. That's the way it was supposed to work. What they would do is the bank would be closed for a day and then they would merge that bank with a healthy bank. The way it stands now with what they have written into, I think it's the FDIC bylaws, I'm not sure, but they've written in bail-in language as opposed to bail-out language. So basically what you're looking at is the template, if you will, from Cyprus, where your bank closes, you can't get your money, and it reopens in a few days, but guess what? You took a 30% hit, 50%, 70% in the case of Cyprus, or more. And that's how they're going to try to make banks solvent again by using customer funds. And understand, when you deposit money into a bank, it's not a deposit. You're loaning the bank your money. You're a creditor. You're a creditor of the bank. And just as in any bankruptcy, if you own debt and it goes through a bankruptcy proceeding, there's a haircut. And the haircut is decided by the judge based on, what they view the needs to be. And there's negotiations, et cetera, et cetera. But the bottom line is creditors don't get back 100 cents on the dollar. And you are a creditor at your bank after you give them your money. So don't expect, if your bank closes, don't expect to get all your money back.
Can people just go and get $10,000, $15,000, $20,000 out in cash if they wanted it? Do they still question you on what you can take out?
Yeah, of course. I mean, if you're going in and asking for cash, yeah, they're going to ask every time. And especially when you go over $10,000, you got to fill out the forms, and they'll ask you what it's for. And I mean, you could just say, I don't think your bank is safe. But I wouldn't just walk into my bank and say, I want $50,000, because they probably don't have $50,000 in cash. You probably want to call your bank manager in the morning today and tell them, I'm coming in tomorrow and I want to withdraw X amount of dollars and I want it in cash. Because they simply don't have the cash available. I mean, if you had 20 people all wanting $50,000, $1 million, there's no way the bank has that on hand. Assuming that you did go to your bank and you did pull cash out, and depending upon how large of an amount, I mean, obviously, if you pulled out $5,000 or $10,000, you could probably go to a local coin dealer give them cash and get gold or silver or what have you. But if you're talking bigger money and you've taken cash out of the system, coin dealers don't take cash. And that's because, they're subject to the anti-money laundering laws. So if you take cash out, now what do you do with it? And it's in the form of cash. You're far better off making a purchase of gold and silver and wiring the funds. So that way you have real money in hand.
So let's just talk about gold for a sec, because, if we go back in time, when we had the Great Recession, gold hit an all-time high of 1900, and we're back to that point once again, where gold is, I think it's like 1910 or something like that. We're at 1900. Do you think this is because of the inflation, because of rising fuel costs, because of the economy breaking down? Is that why gold is moving up now?
Well, gold and silver have both been moving up, and I think that's a function of the demand is outstripping the supply. The reason the reason for the weakness after the great financial crisis, while the Fed was doing trillions upon trillions in loans and QE, and the Treasury with TARP all the way back to 2008, and then the Treasury sending out trillions in 2020 because of COVID. The reason metals were not performing is it's simple. What they actually did was they were selling paper contracts, derivatives that are unbacked, no gold, no silver behind them. And what you had, and still have to an extent, is the tail wagging the dog. The tail being the derivatives market, the futures market, versus the dog itself, the physical market. But you are starting to see a separation now, and that separation is the premium that you have to pay to get real metal in hand. Getting real metal in hand, that's the real price. The fake, and when I say fake, think about this. If you understand that we have lived through and are living through a period of time where pretty much all news is fake. All mainstream news, the narrative, everything that you're fed is bullshit. So if you understand that, then why would you believe that an ounce of gold is only $1,900 and an ounce of silver is $2,450 or whatever it is? It's not. You cannot purchase physical metal for that. And, I've talked about this for many, many years. At some point in time, there is going to be a cash call where these contracts step up and they say, I don't care about bonuses for not taking delivery. I don't care about anything. I want to take delivery. And when that day comes, then you will see a failure to deliver, and then you'll see the concept that Free Gold has talked about. You'll see real clearing prices for gold and silver, and they will be many, many multiples of where the pricing is now.
I think on usdebtclock.org, I think they're saying gold, if you go back to the 1911 calculation all the way back then, it's something like 25, 30,000 around that area. Do you think it's going to go that high?
In my opinion, that when all is said and done, that's going to be laughably low.
Really?
Yeah, you're giving too much benefit to the dollar itself. I did a calculation, and I'm going to say this was 3 years ago, when the debt was something like 22 or 23 trillion. If the U.S. had to pay their debt off with the gold that we supposedly have, and hasn't been audited since 1956, so you got to trust that gold is actually there, and I highly doubt it. But based on their numbers on the gold that we supposedly have versus the debt that we had at the time, the number was $87,000 an ounce. And it's well over $100,000 an ounce now if you had to fund just the on-books debt of 30 trillion. And I say on-books debt because if you look at all the total promises that the U.S. has outstanding, Social Security, Medicaid, Fannie Mae, Ginnie Mae, just all the guarantees, it's over $200 trillion. So now you'd have to add a zero to the number basically that I calculated a few years ago.
Since gold now is above 1900, and we saw this back in 2010 going into 2011, do you think they're going to use the paper markets once again to try to stop it? Because what happens when gold goes to 2000 or to 2500 or 3000? Will they allow it to move up like that? Because what you're saying is they need to maintain control.
Right. I think actually this week is quite important because we're in the period of time where we're coming up on final notice day. And I mean, you can look back several years, many years, where going into the end of the month where the first notice day comes up, then you see the spreads being lifted. And what they do is they just dump the long side. And that's how they've basically pushed the price down. So we're in the period of time in the month where gold and silver should be weak. Now, obviously, with what's going on in Ukraine, you may have extra strength, and it may thwart their ability this month to push pricing down. Once there's a flood of delivery demand and there's a failure to deliver, then that game is completely over. I mean, I could envision, we've said this for years, is that we could envision COMEX pricing, for instance, on a gold contract, you could see it at $10 offered, whereas on the cash market, you could see, pick a number, 3,000, 5,000, 50,000, who knows what the number is, but nothing offered.
Right.
So you could see that you could jaws opening between the paper price and the physical price, and that should be a key. If you see premiums expanding further than they are now, and you're looking at historically pretty high premiums, if you get much bigger premiums than they are now and they start to open further, that should be a key to tell you that something's going on behind the scenes, and a failure to deliver may not be too far off.
So let me go back to our original question about inflation, about the Fed raising rates, and if they're trapped and they can't control inflation, and if they raise the rates and it brings down the economy, or if they stop raising the rates and inflation continues on, are people going to see this as, okay, the Fed has no way out of this? Now gold all of a sudden starts to move because of their inability to do anything about inflation. Because as inflation picks up, just like fuel prices pick up, this is going to ring alarm bells, isn't it?
Yeah, and you need to bring one more thing into that equation, and that's the real economy. And the real economy already is starting to roll over. So you've got, understand that inflation, when it first starts, feels good. Mm-hmm. And that was last year, because your house went up 15, 20, 30%, whatever.
Yeah.
There was money in the streets because of the COVID cash. When inflation first starts, it feels good. But then reality starts to bite, meaning your salary or whatever is not keeping up with the cost of goods and the things that you need to do. And the real economy is already rolling over. It's rolling over at the same time the cost of energy is going higher. That's a tax. And the inflation is going higher. That's another tax. And on top of that, the Fed says they want to tighten. I mean, I just have one word question. Really?
So do you think the economy is going to crash, or are we heading to a crash?
I think, and I've said this a couple times before, I think sometime by the end of this year, humanity, or man, if you will, is going to turn back to God, because times are going to be so bad. And it happens. I mean, just look throughout history. We've lived in a fantasy world for 20, 30, 40 years. We've lived on a credit card. We've lived on debt. And now it's caught up to us, and it's time to pay it back. It can't be paid back. So to answer your question, yeah, I think you're going to see an outright collapse of the financial system, and the core of that is not. I mean, it would be included with the stock market, but the core of that is going to be the credit markets. And I've said that all along, is that the credit markets will burst. And when the credit markets burst, distribution of goods will not happen, because credit is used in everything that's made, everything that's transported, everything that's delivered. The world does not, the real economy does not work without credit.
So you're talking about like the supply chains, like we're seeing now where there's problems. This is just going to be multiplied.
Oh, the supply chains that are already wobbly are going to be crushed.
Wow.
And I just want to mention, I obviously hear all the time the question you asked: how high do you think gold's going to go? How high do you think silver's going to go? And then you get the question, when do you think it's going to happen? I just want to say, be careful what you wish for, because $100, $200, $1,000 silver, you're talking about a Mad Max world. You're not talking about a world where, oh, I'm rich, let's go out and spend $1,000 on dinner tonight. Well, it may be more than that because of the inflation, but I mean, there's not going to be places open to get a nice dinner. I mean, you're going to be scraping for rice and beans.